that major drop in oil fueling the massive sell-off today, or at least a big contributor. Crude down 25%, biggest one-day drop since 1991. The energy stocks, they got, obliterated. I don't know if that's too strong of a word. Probably not. You had Occidental Petroleum losing 52% of its value today. Apache, Diamondback, Marathon Oil losing 40+%. You name it. Let's bring in Mike Bradley of Tudor, Pickering, and Holt. He's been on the front lines of this. We've been talking for about 2 years on this debt issue out there, Mike. So tough day to have you on, but we certainly appreciate it. And did the market deserve, a terrible word, I guess, should the market have sold off the way that it did? Did Occidental deserve to lose 52% of its value today?
Yeah, I don't know. Look, I think the biggest issue with today's market was not only crude oil prices, but the debt markets really came apart today. You're seeing some really high-quality E&P names where the debt was, par 2 days ago, and now is trading at 60, 70 cents. I think that was the big driver. Illiquidity in debt markets really took some of these equities down, and anybody that has any leverage on the system and anything is questionable, it's just got destroyed today. And so that was the main driver. It's probably been, it feels very much like Q1 of 16 when we saw, high yield books blow up and debt really fall out of bed. That's what today felt like. It felt like a lot of illiquidity, and it felt like it was less about crude oil and more about just fundamentals, financials, and debt for these guys.
Do you think, we asked this on a macro market level, Mike, I'll just focus on the energy stocks. Do you feel like today was the washout? Nobody seems to agree it is for the macro market, but for the energy stocks, was today the worst it gets?
Yeah, it was pretty bad. Look, we got some of these things are so technically oversold here. But the one thing we would say is that we did not see a lot of guys stepping up to these names today. I think what people are looking at is, okay, is this going to be a 2 or 3 month issue with OPEC and with coronavirus, or is this going to turn into a 12, 18, 2-year type event? And I just don't think a lot of people right now, are falling either way at this point in time. So I think it was warranted. Probably, it's probably oversold today, but I just don't see really many buyers coming into these stocks at this point in time.
Hey, Mike, it's Tim. Again, thank you for joining us. Crazy markets. What does it take to be a hero in terms of doing the balance sheet work and assessing some of these first lien loans? And again, our viewers aren't trading in this stuff, but you are. And at some point, valuations matter and things get kind of, credit can be qualitative. It's also a numbers game. What do you need to see?
We just don't see a lot of people buying these stocks yet on valuation. It really is certainty. And you saw it today. A couple of these E&Ps came out. They cut spending pretty aggressively, and you're going to see them. A couple of these E&Ps are just not going to grow next year. In fact, they're probably going to decline. I think that's what people are wanting to see. They're delivering it, and those stocks outperform. You're going to see a massive amount of announcements over the next probably 2 weeks. You're going to see production. You're going to see CapEx coming down probably 30 to 35, 40%. And you're going to see production next year is going to be declining in the U.S. It's going to be the first time we've seen this in probably 4 or 5 years. I think that's what market participants want to see. They want to see a healthier market. It's getting washed out. Valuation will matter at some point, but we've got to get the coronavirus uncertainty. And we've got to get the uncertainty on OPEC, what they're doing right now and how long are they going to take this.
Well, we know what they're doing, which is they're fighting. And they've all retreated. It's every country for itself and every company in America for itself. Oh, if we could, guys, can we bring up a 10-year chart of the XOP, the Oil and Gas Services ETF? Because I want to focus on this, Mike. The XOP, it's a widely traded ETF. It's down 89% from its highs of just a couple of years ago. 89%. In other words, the market is predicting that many of these companies, and I don't think this is hyperbole or some sort of, fear-mongering statement, are going to go out of business. Is it that bad?
Yeah, you're probably going to see 15 or 20% of the companies will probably go out of business. But, I think what's going on right now is that, it is uncertainty and people are scared. What are we hearing from clients right now? Everybody wants to see these the companies on a $35 strip, into infinity. You don't usually see that at tops. You see that at bottoms. And so, when you say, you start dialing $35 oil, flat for 2 or 3 years, the valuations don't look good. We don't think oil is going to be at $35 a year from now. We think it's going to be higher. And so, yeah, we probably are in the 7th or 8th inning of this. It doesn't mean it can't get worse, but, we're seeing some good values. We're telling people to stay in the high-quality names. That hasn't really worked up to this point in time because everything's getting thrown at it indiscriminately. But, yeah, I think the industry is going to be healthier here in the next 12 to 18 months, and I do think that's going to be enough to bring generalists back to the group. Generalists did not want to get in this group simply because companies were just spending wildly. They weren't generating returns. They're going to be generating better returns, and when oil goes back to 45 or 50, the returns on capital are going to be pretty significant.